Welcome to the game of trading, level 1 understanding. We're going to be talking about the bank's business of accumulation distribution. So the very first lesson that you need to learn in being in this business is that it is not your business. This is the business of the banks, the market makers, and the institutions that run the money of the world. You are merely a participant in that business. That all being said, there are great advantages to being in your position, which we're going to cover here throughout this course. But the first thing that you need to learn is whose business it is, how they operate their business, and how you can interact in that business for your own profit. The majority of the big money of this business is made through the model of accumulation and distribution. So what is that? Well, it's pretty simple. I want you to think of any normal business. This could be a business that's just in your neighborhood, some sort of shop somewhere. Okay, that business wants to sell stuff. But what do they need to do before they sell their stuff? Well, they need to accumulate an inventory. And preferably, they're going to want to accumulate that inventory of product or goods at the lowest possible prices so that they can then turn around and sell or distribute that inventory to their customers to make a margin or a profit on those goods. That is the basics of accumulation and distribution. So why is understanding accumulation and distribution important when it comes to the markets? Well, just like other businesses, operating in the financial markets is the business of buying and selling things for profit. When you accumulate shares of a stock, or you get some sort of cryptocurrency, or you secure a position in Forex, that becomes your personal inventory. And it is typically most people's goal to distribute that inventory later to a willing buyer at a higher price and make a profit. It's no different for the banks. The difference in the financial markets is that 95% of businesses or traders cannot make a profit. That's the failure rate. So you have out of 100% of traders coming in, bringing their own personal business and trying to accumulate their own inventory, 95% of them are going out of business. By the end of this course, you're going to know exactly why 95% don't make money in this business. But for right now, what I want you to take away from this is that it is absolutely important that you learn and follow the business plan of the 5% who consistently accumulate and then sell their inventory for profit. So there's no ands, ifs, or buts about it. Successful predictions make successful trading. So to best understand how to predict future prices, you must first ask, who has the power to move price? Why do they move price? And how do they move price? So let's answer those three questions. So let's start with the who and the why. Who's moving price? Simply put, the banks. Who are the banks? Well, it starts with your Goldman Sachs's and the JP Morgans of the world, and then it goes all the way up to your central banks like the Federal Reserve. These are the banks that are moving price around. Now, the two primary profit centers for the banks in general are going to be the following. One's going to be market making, and the other is going to be proprietary trading. So what are those? Well, simply put, market making is facilitating transactions, matching up willing buyers with willing sellers, and then making a spread on the middle of that transaction, a little fee. The other one is going to be proprietary trading. That is filling up your own inventory full of positions that you want and then selling those later for a big, massive profit. Those are the two profit centers of the banks in general. So the next question we're led to ask is, why do they do it? What's the motivation? Well, obviously there's a motivation to make profit, but why do they want to make profit? Well, when you already control all the money in the world and you're at the central bank level, what else do you want after money? Well, you want control. So the more profits they make, the more control and influence they could implement on the world economies to do whatever it is that they want to do. I'm not going to get too into the weeds on that. You can use your imagination. But those are the motivations of the banks at the highest levels. And just to give you some quick reference, Goldman Sachs reported $11.3 billion in profit in 2022, and this is mainly due to investment banking, market making, and proprietary trading activities, same things listed above. And they are a relatively small bank on the world scene, just to give you some reference into the global scope of what's going on here. But the real question that we're all interested in is the how. How do they make their money? How are they actually trading for profit? Well, again, it comes back to the basic business of accumulation and distribution for profit. but how do they get their deals on inventory? How do they buy something low and know they're going to make a profit? That's the key here. And simply put, it's through the manipulation of the laws of supply and demand. I'm going to get much, much deeper on how the markets are actually manipulated. But for right now, I want to show you an example of how accumulation and distribution works. Taking a look right here, you can see that we have a chart that's kind of trending down. And you see we have these green dots. Well, these green dots represent the accumulation of inventory. So we see that the bank accumulates buy inventory from willing sellers. That's a key point. Willing sellers are coming into the market that think the market's going down further, and the bank is accumulating the other side of that inventory, buying it for themselves. Then what happens? The market moves up into the distribution phase. The red dots represent the distribution of that inventory for profit. What the bank bought earlier from willing sellers, they are now selling to willing buyers. And that is the key thing that I want you to understand here, is that there's always a willing buyer and a willing seller. You understanding which one of those to be at the right moment is key to your success. Even though this is not your business that you control, you do have a business within that greater business that you have to run effectively. And I think a lot of traders lose sight of the very pure, simple nature of the business that we're all involved in, the business of trading. So I made an example to walk you through a visualization of how that business works. The thing that you need to understand as a trader is that the market is nothing more than a large crowd of people with their own individual beliefs about what's going to happen, their own individual opinions. Every decision that they make, every action they take is because of a change in those beliefs. So keep that in mind. So in our illustration, we have a willing seller that comes along with the belief that the bull run, the market rising, is now over. And they want to sell their 100 shares for the market price of $1,000. We're keeping the math real simple here, okay? You come along as the trader. Your belief is, I think there will be more buyers at higher prices. I'll buy your shares for $1,000. You are doing what now? You are accumulating that inventory to distribute it later on. Then comes along your willing buyer. This stock is going to the moon. I need 100 more shares. Well, guess who has 100 shares? You do. So you say, I'll sell you my 100 shares for $1,500, the new market price. The willing buyer says, done. I think it's going to keep going up. So what's happened here? Well, to simplify it, we had the first transaction, which 100 shares of inventory accumulated by you, the trader, went into a holding period. You were waiting for price to go up and appreciate. And then what happened? 100 shares of inventory was distributed by you, the trader, for a $500 profit. That is the simple cycle that you're involved in as a trader. You want to do this as many times as you can and as profitably as you can. So your single biggest job as a trader is to consistently make quality market forecasts, accumulate discounted inventory, and then sell that inventory for a profit, which is what this course is all about, teaching you how to do that. But if you're just getting into this business, going along with what we've been talking about throughout this entire lesson, you need to do an industry appraisal. You need to ask yourself, who is the best at accumulating and distributing inventory? Because that's how profits are made. Who's the best at that? The banks are the best at that. So it would make sense that we mirror their business model. The banks are running a never-ending business cycle, and you could think of this business cycle in a circular model fashion. Starting at the top, the banks are accumulating sells after a big move up. They're accumulating short inventory in preparation to distribute that for profit as the market moves down. The market eventually moves down, and the bank starts distributing to willing buyers and collecting profits from those short positions. As the market enters a bottom, the bank starts accumulating buy inventory, starts doing the opposite. Eventually prices move up, then they move into their distribution phase, take the profits off the table, price slows down, starts consolidating, and then they do it over and over and over again, accumulating shorts, accumulating buys, and then distributing into the rising and falling markets for profit. In the middle of all this, we have the weakest traders. And you could think of the weakest traders, the ones that don't know how this works, don't know what to do, They are serving as the fuel of this market. Smart money requires dumb money to exist. You want to make sure that you are not part of the dumb money and that you understand how the cycle and the business of the banks and the market makers work so that you can see what they're doing and join in when you understand what their game plan is. So as we wrap it up here, what's the takeaway from this lesson? Simply put, again, this is not your business. You are a participant in a much bigger game between world banks and institutions. And if you want to operate successfully in this business, you need to study why and how they move price. That is your only priority, is to learn how the banks make their money, why they do what they do, how they do it, and then follow them. That is the entire focus of your study as a trader. If you figure out what they're doing, then you'll know exactly what it is that you should be doing.